Welcome, everyone. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And you're listening to the What Matters podcast, and our mission
to spotlight top RIAs, wealth managers, and investment professionals who are redefining wealth management.
Join us as we dive into their journey, strategies, and insights.
Whether you're an investor or an inspiring pro, this is for you.
Get ready for impactful conversations on the What Matters podcast. Hey, everyone. Welcome to another episode of the What Matters podcast. I'm Mike Mershazadeh.
And I'm Ashley Ward.
And today we're joined by our esteemed guest, Wally Obermeyer. Wally is the president and co-founder of Obermeyer Wood Investment Counsel located in Denver and Aspen, Colorado. He also chairs the firm's executive and investment committees. Wally has been recognized for more than a decade in leading industry rankings, most recently by Forbes in the top wealth advisors in 2023 and best in state wealth advisors in 2023 as well, and Barron's top 100 independent wealth advisors and America's top independent advisors in 2023. Quite a year for you. Welcome, Wally.
Oh, well, thank you. It's a pleasure to be here. And I just have to say, particularly among the independent advisors, there's an incredible camaraderie of shared goals of just really trying to help clients. So I'm delighted to participate in this and recognize that I've also learned a lot from so many people in the industry.
Usually Ashley gets started off, but I had a couple questions out of curiosity because in going over this, and I read it last night, and I was like, wow, I mean, these are quite some accolades for 2023. Do you mind, peppering that in and talking to us about it, and what went on in 2023 to make it such a year for you guys?
Well, first it's really sometimes I'm named, sometimes the firm is named, but it's really a really broad team effort. And I would say there's just a lot of energy in our firm, largely by everybody just working together. And then also I would say the last, probably 7 years have just made so much progress in terms of bringing in younger people and into the firm. And it's amazing somebody with maybe 1 year experience finds a place to really contribute. And so the people who've now been here, they're having maybe their 5-year anniversaries now, are, just have a huge amount of traction in terms of what their contributions are. So it's a team effort, and it's cumulative, even though a lot of the accolades may come all in 1 year. It represents years of sustained effort.
Because I show here that you guys, have a roughly, and you can correct me on this because, ultimately this information is mostly wrong, but over 2 billion of AUM. And how much of that has been grown over the last 7 years?
Quite a bit. And I think, and I don't know where we are today, it is between the 2 and 2.5 somewhere, and it depends on the markets. But I think, most of our businesses grow largely from client referrals, from happy clients. It's still word of mouth. And certainly the rankings help. Some of the new business comes in from that, but a lot of it is reputational, and that's kind of cumulative. So it's both cumulative, and then you gain momentum, I guess.
Yeah. And I know that, with where you guys have grown in the last 7 years, you said that you've added a lot of younger talent to your organization, which, I'm a huge fan of because, Ashley has been with me for close to 7 years now. I had gotten her right out of Tucson there. But when you said that you had brought in lots of younger talent there, these individuals have ultimately grown over the last several years. Have they, taken more of active management roles in the company for you to be able to take a step back, or how's that been operating?
Well,
assuming that you're taking a step back, right?
Yeah. Well, I just mentioned my dad will be 104 next week.
Wow, that is
And
awesome.
we have a family ski wear business called Obermeyer. It's Obermeyer Ski Clothing. He still goes into the ski wear business, into the office, usually a couple times a week. So I I don't have any plans for stepping back, but we have a very well coordinated team, and they do. I'm one person who contributes, but there are many of us, and so it's a collective effort.
Real cool. How many total advisors and total employees you guys have these days?
Oh, I think total employees is probably 24-ish. I could be wrong by a few number, and then we probably have. Uh, uh, I'd have to look to be totally accurate, but they're probably around 8 or 10 of us more on the advising side.
Really cool. And my last question before I hand the mic off to Ashley here, you said your father. I've and I'm pretty familiar with your father's line there, right? What my father owned gas stations, so naturally I didn't want to follow in his footsteps because they say your parents should never give you your first business or your first job, and it was mandatory for us, right? So we had to start working at the gas stations. I think first or second grade, my twin brother and I did. So still to this day, when we go to gas stations, it's I always strike up conversations with the cashiers, right? So when I can lead off with that, your father having this I'll call it a textile ski brand, right? We'll call it. What got you into wealth management as opposed to following in the family business?
Well, I won't give you the long story or the super short one, but somewhere in between. The real advantage of growing up in a family business is that you're exposed to so much. I would travel around Europe with my dad and on buying trips as a little kid, and working in the warehouse, and just always talking shop. And so you start to think about business. And so for me, I always knew that I wanted to be in business, and I think you're kind of more exposed more to an entrepreneurial setting. Uh, and so at a young age, I got to do a lot of things, even within that business, including just a few years out of high school where I convinced my dad to let me computerize the business. We were on almost the bleeding edge of that, but it made a huge difference for that business. And I learned a ton about computers in the process, hired programmers and so forth. So but specifically with the wealth management business, to tell you the truth, I had gone to business school. I had developed a hydroelectric project down near Durango, Colorado, that still own and operate, and that produces power for about 5,800 homes. Kind of is the maximum power it produces. And so you could say I was early into clean energy on that, but then went into the family business and was starting to make decisions that my dad wasn't real comfortable with. And I thought, this is crazy. If he were to retire, he might lose his zest for life. I should go do something that I have an interest in. And one of the things, and I'd learned about Warren Buffett. Both I studied economics in college and then went to business school, and from another very close friend of mine. And one of the things that Buffett said, that he's a better businessman because he understands capital allocation well, and he's also better at capital allocation because he understands business. And so initially I thought, gosh, I should spend some time on capital allocation. And I had a stock picking class in college and ended up having my term paper published in the in that college's economic paper. What it was, and people really liked the approach that I took with it, and so
is this when you were at Harvard?
Correct. Yeah.
Wow.
Yeah. Well, that's quite an accomplishment there.
Yeah. Well, thank you. Yeah. and so so I had an interest in capital allocation, but thought, gosh, I should do that, and I ended up joining a what was an independent trust and asset management company, and then in my deal with them had negotiated a buyout option if that business were sold, and so I acquired then the Aspen portion of the business that I had created, and that's how our firm got started. And I correctly anticipated that the investing would be, very interesting, and I really enjoyed it. What I had under anticipated is how much I would enjoy the people side of the business, meeting the clients, helping them, basically being their servant, of service to them and helping them. And so that's really what kept me. I thought I'd do it for a few years, and then I think, gosh, this fits me really well and fits my personality well.
Real cool. And this is another question out of curiosity. So your father being 104 years old, congratulations to him again, by the way. He outlived Munger, right?
Right. Yeah. Exactly.
And with that said, did you have other siblings that took over that business, or were you the only one that had went and did your own thing?
Well, we first we have a very professional team there that's very well run. I've been vice chairman of that business for many years and help with it. I have a brother who's like my dad, also named Klaus, who is helping more. So it's really a family effort. My stepmom is still involved in it, and so we have professional management, but the family members stay pretty involved as well.
Real cool.
Very cool. And let's talk a little bit about your firm's success. So like Mike said, you've been consistently recognized for excellent and received plenty of recognition and awards. Can you tell us how do you measure success as a financial advisor in your field?
Well, I think, are we good stewards for our clients? I would say that this is probably true in business overall, that, if you want to focus on adding value in whatever business you have. And if you do a good job with that, you'll also make a good living, and your balance sheet or your income statement will reflect that through time. But don't focus on how much money you make, or your kind of your personal report card that way. Focus on the end client. How much value are you able to add for them? How can you continue to increase that? So that's a much better goal to focus on than kind of what comes out on the back end on how you might do personally. And I would submit that if you focus on the former goal, you'll also do better for yourself in the end as well.
Yeah, I agree. Because money is always a byproduct of you doing your job well and enjoying what you do. And if it's the last thing that you worry about, and you enjoy waking up, and you enjoy, getting behind your computer, and you look forward to seeing who's emailed you, or who's left a message for you. And, I know that a lot of individuals, they dread doing that. Right. And, I know for, myself, I'm always very excited to get up. First and foremost, because I'm a horrible sleeper, but I love to see who's gotten back to us, and I spent several years prior to this being, 26 years in the mortgage business. And, that's where I'd met Ashley. And before getting into private equity, we sold that company in 2020. And with that being said, I could say that I loved that business, probably up into the last 2.5, 3 years that I was in it. And man, it just gradually went downhill. I think towards the end, before we had sold the company, and Ashley could attest to it, she probably saw me, I was in the office once a week. Right. So ultimately, with you, and going into your office, every day, or, how often you go into it, do you obviously look forward to going in? Do you have a book of business that you still manage, and do you still keep active, or is your role more mentoring these newer individuals that are at your company?
Yeah. Well, I think it's largely mentoring, but I also think that I'm a person who am best influenced by examples. I see people who I'd say, gosh, I'd like to be more like him or her in this regards or in these attributes. And I think given how I'm wired, maybe that's kind of my leadership style as well. As if you set a good example yourself, you set the example of how you think things are best done, then people follow. But I think back, Mike, to your earlier comment about the mortgage business and timing. It's so important to be in a business that one loves.
Yep.
And that also that it's with a good group of people. I have my wife and I are part of a merged family. We have 5 kids between us, and most of them are kind of beginning their careers. Some are a little bit further along. And what I'm most stressing for them is pick people who have good values, people who you would like to be more like, people who will mold you. And I think that we're much more affected by the environments that we place ourselves in than we acknowledge. We think we're pretty strong and we go, but we are so affected by that environment. If we recognize that, and then are lucky enough to find an environment where we really are positively influenced by the group which we're part of, that's such a good thing in life. You mentioned Charlie Munger, who passed away yesterday. What an incredible life story he has, and the long-term relationship between Warren Buffett and him, and how much that changed both of their lives. And so just highlighting the importance of being with people whom we really respect, who we learn from, and whom around we always want to be our best selves.
About 4 or 5 years ago, I was invited to this, it's this quarterly meeting, I believe, that is a quarterly meeting. I believe they have it. I don't know if it's quarterly or twice a year that Munger and Buffett have. And, and it's where they're sitting there and, they're going over and picking stocks. Right. And I'm not kidding you. Between the two of them, they probably went through 12 to 15 Cokes and cherry Cokes, and they probably went through a pound of peanut brittle minimum, right?
Yeah, I've attended a number of those shareholder meetings, and we have a big group from our firm that goes every year. And I remember one year a shareholder asked, shouldn't you maybe at least on behalf of your shareholders eat more healthfully? You're up there drinking the diet cherry Cokes and eating peanut brittle, And
They said
Buffett,
they have to support their companies, right? They own Coca-Cola.
Well,
and
Buffett
McDonald's
made a very interesting point. He said stress is the biggest killer of them all. And Charlie and I have no stress. We absolutely love our jobs.
Yeah.
And I think that is so important. Now, I'm also a believer in eating healthfully and exercising. We just, by the way, we normally review a book every quarter in our newsletter and offer a book to our clients. And we reviewed Dr. Peter Attia's book Outlive, which I've also given away probably half dozen or a dozen copies to various friends. So we think it's all important, but loving what you do is really important.
And so, you said you have a blended family with your wife. How many of those 5 kids have opted to get into your business?
None so far or directly, but nor has there been any pressure. I mean, I want for everyone, and I think for to take paths that where in areas that they have an interest and inclination and talent and so forth.
So I was going to ask a little bit about the future of the firm. So right now we don't have any plans for any of the kids to come in and take it over. So what do you see as the future for Obermeyer Wood?
Well, I think a couple of things. One is I would first acknowledge that there has been a lot of consolidation in the industry. And there probably will be. And I have a few peers who have gone that route with their firms, and at least at this juncture, they feel very good about it, and so forth. For us, we are fiercely protective of kind of our group and our ability to continue doing what we do. And love the autonomy that we have and so forth. And I anticipate that we will continue to, we're organized technically as a limited it's a mouthful, limited liability, limited partnership, an LLLP. And I have no intent on selling or exiting. This is a business that I think the rewards of the business are cumulative. It's kind of, you build your reputation over years. I tell people that we're in the business. It may sound almost as if I were maybe from Sino, and I say we plan to be in this business for centuries. And so it's certainly multiple generations. One thing, by the way, that works really well is by having advisors of different ages. We often will pair younger advisors with the younger generation.
Sure.
And that works so well. So I'm dragging on that. I forgot where we were going with it. But
that actually leads me into a question there, because, with you guys having, 6 total advisors now, obviously you're majority shareholder. I take it. And at what point did you decide to give the other 5 individuals ownership in the company? Obviously, I love the strategy, I should say, because, they're with competition in the marketplace, to keep your advisors around, giving up equity in the organization is brilliant, right? Rather than, a lot of people, I see them doing nowadays is they run a TAMP type of company where they just board a bunch of 1099 advisors. First and foremost, whether there's no exit or not, there's not much alpha and valuation in the organization, because, if you have a bunch of 1099 advisors, they're never selling the company. They're just selling themselves, right? They could pick up and, will their book go with them? That's always subjective. But I think that I like what you've done there. But at what point did you decide to give up to give up equity to these individuals, and how did you come about with that?
Yeah, I think that was about, gosh, time flies now. Coming up on 10 years, I think maybe it's 9 years ago or something. We merged. It was kind of a merger-friendly buyout where my predecessor firm, Obermeyer Asset Management, merged with Wood and Company, and so and then slowly, in a sense, we were my partner George Wood. We were his exit strategy, and I credit him in terms of really caring about his clients and wanting to create a future that was good for his clients, and it was good for us. We had a number of his team members who together we were stronger.
Yep.
And so, but we used that transaction, that merger, to broaden ownership, both on what was George's end and my end, and that kind of set the stage for that. And it worked well. It was a lot of work, but we had very shared values, and we literally powered through and better for it.
Is he still a partner in the organization as well?
So we're right at the end of November. He is, but that finally concludes at what we expect at the end of this year. And so some of our existing team members will increase their ownership.
Oh, cool.
And let's go a little bit into the future of wealth management. What key trends and technologies or strategies do you foresee shaping the landscape of wealth management in the coming years?
Well, actually, I think one of the big things we're seeing, and of course people have been calling for this for at least a decade, is the big kind of demographic transition of wealth from the older generation as that generation passes, and estate taxes are still relatively low by virtue of the higher exemptions, and the younger generation receiving a lot of assets. So we see that happening. I think as all of our firms have an increasing number of younger clients, they're digital natives. They are used to having more real-time information, having their balances and consolidated information available on their iPhone. And so we see, I think, better communication and more real-time communication. I compare it a little bit to what I really like about using Uber or Lyft versus calling the taxi cab company is I can see the cabs or the cars on its way. I know what the charge will be, and I have better information, and that gives me a sense of being in control on when will I arrive, or will I get to my flight on time, or whatever. And I think clients these days also appreciate better information within our function or what we're able to deliver. So we've made really good strides internally at keeping clients aware of, let's say, if new accounts are being set up or assets are transferring in, or of notifying clients that this transfer is now complete. We're still waiting for cost basis information, or just keeping clients up to date so they don't have to reach out and ask or wonder, but that information is in front of them. And so I think there'll be more and more of that. There are increasingly better tools to help deliver that. But that's a trend that I think will only intensify.
Well, Wally, I think you're going to have to back up a couple moments there. I'm not sure Ashley knows what a taxi is. right?
Yes, I do. Uber didn't come out till recently.
I'll tell you, we have a neighbor who's from New York City. Wonderful guy. I haven't seen him for a few years, but he has a dog named Taxi. And that dog, I live out kind of in the country on a 5-acre block. That dog runs away. So he comes to the top of my driveway and he'll yell at 5 in the morning, taxi, taxi. He's looking for his dog.
That's funny.
So,
Well, having myself lived in major cities like San Francisco and New York, like Los Angeles, taxi cabs were the way of life up until, gosh, I mean, just not even a decade ago, right? And they always overcharged you. You always got ripped off. You'd call them and you'd be on the phone with some dispatcher that essentially, was talking to somebody over the phone that showed up, or maybe not, 50% chance in 30 to 45 minutes. You never felt safe in the car, and the cars were never, I will say this kindly, sanitary, right? And that's the experiences that I had gone through. So when, Uber had came out, I was thrilled. Here in Arizona, we have what's called Waymo, and it's the driverless Uber. They are all around here, and so that's. Do they have those in Denver or where?
They don't. Although I was not too long ago. I think I was in Austin, and I saw a lot of those being tested.
Yeah,
which is neat to see.
So let me ask you this. Obviously with you guys have had some growth, you said, over the last 7 years. What's your what's your projection for the next 7 years? Where would you guys like to get your AUM at? What do you see going on from now till 2030?
Yeah, I think I think we'll continue at a good rate. If we grow at, say, 15% a year, and you double, you could use the rule of 72. Double in 5 or 6 years, we'll be really happy. Growth is not the most important thing. I think if we continue to take care of our existing clients well, and they're really then basically clients for lifetime, our lifetime or the business life frame, because we work very hard at getting to know the next generation. And it's not unusual that we'll be working for 3, sometimes really maybe working for 4 generations at once, maybe working with 3 because the youngest is not of age of majority yet. So I think a big part of growth is to continue to service our existing clients well. They give us the referrals. If we're doing a good job, we get to know the next generation and maybe the next after that. Those assets stay with us, and we continue to help them. And it's also just a delight to see some of those clients who are now in their maybe 25 to 35 year age range, who are really gaining traction in their careers and their businesses, and they're beginning to add assets and sometimes have big liquidity events from the sale of a business or something. And so I think staying focused on the existing business almost unintuitively is what leads to better growth.
Right.
Thank you.
And are there any particular investments or sectors that excite you right now?
Oh, there's some dilemmas that you never know, and I think and one of those dilemmas, for example, is as we all know, this year it's really about 7 stocks that have led the market. The
Right.
difference between the Russell 2000 growth and the value index, I think the growth index is up 30 through the end of November, almost the end now, about 34, 35%, and the value index is up, I think, 4%. So huge discrepancy. Now, on the positive side, it means there are quite a few stocks that are pretty reasonably priced. And of course, there's that question is how much further can those few stocks go? How expensive can they get and still be worth it? In other words, will they actually achieve the growth that is kind of built into the price? And so that's the dilemma. We probably some of them will, some of them won't. And so we're in a way both enthused by and pleased that there are a lot that have not had companies that have not had that run up that we believe have very good fundamentals. And then there are some stocks that are really on a tear and indeed may be worth the price given the rapid growth. So, and none of us know for sure what the answers are on that, but I would say that there's both an opportunity and some risk embedded in that decision making. I think in general, AI and will be a good thing for the economy. A downside is that it will reduce and eliminate certain jobs, but in a way it makes us all more efficient. It's a little thing, but it's nice for our clients where they can get on our website and make an appointment and basically see what's open on our calendars through Calendly. And so those types of things make us all more efficient. I think COVID introduced some of those. I pick up sometimes at a Oriental restaurant here in Aspen, take home, and I'll just order it on the app, and it's there to desk or on a table to pick up, and I don't need to do anything other than just use the app. I always thank the waiter that I know there, but so I think that will continue to happen, and AI will give us a bigger boost. There's some pitfalls. I've used ChatGPT some, and it actually, it works pretty well. We had a meeting earlier this week with an attorney, and we're talking about that, and she was saying that the AI has helped in the drafting of documents tremendously, but in a way it's made it harder because now the responsible attorneys need to go through every paragraph and see if it's really relevant. Did the computer put it in the right way, or is there a bug in it?
Right.
And so, I think it'll be a mixed bag, but on balance, it'll help. I'm excited for it, for example, in the healthcare industry where the computer programs can do a better job reading maybe on certain types of MRIs and things than a human can. The computers have seen so many hundreds of thousands or millions of cases that they can become better at it than a person. I'm an avid aviator and have a commercial and airline transport pilot license. And
how does that not surprise me?
But I'll just say that particularly when you're up high, if I'm at 28,000 feet, the autopilot will fly better than I do. Now I hopefully make better decisions, and that's how I program it. But so the computers can do certain things better than we can, I think AI in the healthcare industry will be one where there'll be quite a few advantages. The logistics industry is another one. So
Yeah.
I'm excited about it. I think it'll help propel, increase our economic growth over the next decade.
Yeah.
So you highlighted on a couple of things there that came to mind with me there, because there's that old saying, great stock, bad company, great stock, right? You got companies out there like I mean, this is a Warren Buffett company, and a Munger company, Paramount, right? That and Alibaba that Munger had invested in. Alibaba, trades at like a 12 or 13 multiple. I think as of today, they hit the lowest that they've hit, in they were at $73 or something like that. You got DocuSign and Lyft that are trading at a 3 times revenue or 4 times revenue, when usually those tech type stocks will go for 9 or 10 times revenue minimum. And so with that being said, you said that there's those few stocks that are just driving the industry right now, and you got things like even Tesla or Nvidia that are trading at 90 to 120 150 times multiples there, right? And so ultimately they're going to need to catch up to that if they're going to be trading for those high amounts. What's your opinion on some of these stocks? Do you view Alibaba and I'm not going to say a specific stock, but some of these stocks that I just mentioned as value stocks, or do you think that they'll have a rebound? What's your opinion there?
Yeah. Well, first I'd say, I think we should, at least in our firm, and I think this is probably true for all advisors, that none of us can predict the future. I mean, we can make predictions, but none of us know how things will come to pass. And so I've always viewed it that we endeavor to position our clients in a manner such that they're in at least an acceptable situation, a reasonably good situation under a wide range of circumstances, because we really don't know what game-changing things might happen, and so that speaks to a certain amount of diversification. I think it also likely speaks to a certain amount of style diversification, that you can have some of those where you're paying more, you think that there's going to be great growth, you think that there's a defensible moat, but we also have to recognize that we'll be wrong a certain amount of times. We don't know how things will unfold. I think I personally have been a little bit surprised at seeing on, you talk about the electronic signature business, of which DocuSign is a player and Adobe's a player. I have a friend in the land title business where in their company they've created their own proprietary software.
Oh wow!
And so there is not maybe as defensible a moat around there as what I might have originally thought.
Gotcha.
And so I think it's kind of a judgment call on that. I think in the chip sector, where we see a wide range of valuations, take Taiwan Semiconductor that's at a pretty attractively low PE, and then you have the China risk with it or whatever, and contrast that with NVIDIA, and then a lot of companies in between on the pricing scale. So, probably the thing on there is to diversify on some of that. Certainly that sector will do well, but you wouldn't want to put all your eggs in an uncertain basket.
Yeah. And here's my wrap up question, is my favorite question to ask everyone. Which, we've seen some unprecedented times right now, right? I mean, we, from 2020 when the pandemic hit, we lent out more money than and got ourselves in more debt than we ever had before. Being, in the mortgage business in my previous life, I got in the industry in 1993, I believe, or 94. But anyhow, they were 10% back then. Now, I'm sure you remember the interest rates when they were at 16, 17%, right? I caught it on part of the way back down, but I rode that wave for a quarter of a century, all the way down to the rates hit 2.25%, 2.5%. And, that was when we had exited and sold the company. Now, interest rates on homes are 7.5%, 8% right now. Car loans, 8.5% to 12%, depending if your credit's good, right? We haven't seen these, things like this happen before. The market had, some turbulence last year. We've seen a rebound this year, obviously. But, as you said, it's just, sectional. What do you think is the economic outlook for the next few years?
Uh-huh. Well, I studied economics in college, and one of my caveat expressions is that God invented economists to make weathermen look good. And so I would invoke that here. I do, by the way, think that economics as a study is incredibly important because it deals with people's kind of standard of living and comfort level and well-being and so forth. So I don't want to demean it as a study and as a discipline and as a way to study social organization and so forth. It's very important. I also think that we have, and Charlie Munger was so keen on cognitive biases and that we should be aware of them. I think we have a cognitive bias to overly emphasize the recent past versus maybe the average past. That's what we can recall more easily is what's more recent. And so while we are in our recent past kind of tend to thinking about lower interest rates, if we look over a longer period, higher interest rates have been much the norm. I had a cow milking business in high school, so I was always an early riser and had to be home after school to milk the cows as well. And then when I got out of high school, sold them and bought, I think I was 18, and I bought a condominium in Snowmass Village that was just getting going, and I had a mortgage. And I think that was at about 12 or 13%. So I was used to that, and that seemed like a normal interest rate, at least to me at the time. So we really don't know whether we'll see a sustained era of higher interest rates or not. I think life will be okay either way. One advantage of higher interest rates is that more conservative clients can now invest in fixed income and get a reasonable return, assuming inflation stays low, to have a real return that is still acceptable. And I think that higher interest rates force upon businesses a more realistic or more careful allocation of capital. They won't borrow as much and so forth. So it's not the end of the world if rates stay higher. But I think probably then those people who are paying more attention or maybe have more valuation discipline will likely fare a little bit better than not. And so I don't know which way we will run. I do think that from what we've seen, a fair amount of money has flown out of the banks of deposits and gone into, for example, into U.S. Treasuries, and that will force the banks to tighten their lending. Plus, lending standards and with the higher interest rates, they're higher as well. And so
that's a really good point right there. I never even thought about that.
We may see more of a squeeze. In a sense, they're helping the Fed do their job as that happens. And so we probably will see some more stress in the commercial, I'd say particularly the commercial office real estate.
Yeah.
In certain areas, in large downtown areas, for example. We saw where WeWork filed bankruptcy, and a lot of those leases are at older rates that at today's rates would be lower, and so I think we'll see some more repercussions on that. So it's still a time to be careful and sometimes opportunistic, but I don't think we're through that yet. December will be interesting so far with the after Thanksgiving sales have gone pretty well from what I understand on the small items, but the big ticket items it might be a little slower. So we'll know a lot more after Christmas. In the big scheme of things, I think it's probably smart to focus on good underlying investments and not worry too much about the direction of the economy that is difficult to predict. And another Buffett expression is it goes something like if you spend 30 minutes a year thinking about the economy, you've wasted 15. So yeah, I think we want to take it into account. But bottom line, at least on the equity investing side, trying to own good companies that will do well over a 5 or 10 year period and not pay too much attention to the next 2 or 3 months.
Well, thank you, Wally. I really appreciate you sharing that with us. And unfortunately, we're cutting a little close on time. Could talk to you for so much longer, but we don't want to take too much of your time up today. So thank you so much for joining us today and sharing your remarkable experiences and story. I mean, you've achieved a lot in your life so far, and I'm really excited to see what is in the future for you and Obermeyer Wood. Thank you so much for sharing your insightful perspectives with our audience. We really appreciate it.
Well, it's been my pleasure, and I always think of the kind of the fee-only advisors, the fiduciaries, as the good people in the industry, and we're all pulling in the same direction, which is trying to help our clients and to learn from each other, and ultimately to be good servants to the industry. And so I applaud your listeners as well, and love seeing them at the various conferences and wherever we can help each other to ultimately help our clients is a privilege.
Thank you.
Thank you. And to our listeners, thanks for tuning in to another episode of the What Matters podcast. Join us next time as we continue to explore the exciting world of wealth management and financial innovation. Thanks, everyone.